One thing that we talk about a lot here on the channel are different signs that we can look at that are happening all around us that pretty much can tell us which direction the economy is going to go and which direction is the housing market going to go. And one thing that I've covered a few times here on the channel is how now that we're moving into the recession, into 2023, that more banks and more lenders are going to tighten up their credit lending to people because of the risk that's involved. And we covered how much that's going to happen with credit cards. We covered how much that's going to be happening with mortgages. And now the latest victim of credit tightening is going to be businesses. And here's what I mean by this. About 25% of commercial banks that give loans to medium and large businesses throughout the country have tightened up their credit lending to all these businesses. And this is normally something that you never see unless there's a recession. And on top of businesses being affected, the standards for credit card lending are going up, as well as consumer personal loans as well. Now here's the interesting thing about this, guys. A lot of lenders are restricting their credit access because of fears of a recession, right? They know that risk is greater right now, and it's not the smartest thing to be handing out loans left and right, especially to companies that have less credibility or credit history. And the interesting thing about this is this can actually be a catch-22 in the terms of when these banks start to restrict their lending and access to credit. What it does, it makes it more difficult for businesses to obtain credit, and therefore they scale back their spending. And when businesses scale back their spending, what usually happens next is lower profits, which means more layoffs and less GDP and less productivity in the business world, which can in turn actually either cause a recession or just make the existing recession even worse. And the funny thing about this article where I found this information is a couple things. First of all, they say, well, this is going to increase the risk of recession to 75%. Newsflash, it's already a recession. We've already covered millions of different things that are pointing to the fact that we're in a recession right now. And they also think that because these lenders are starting to tighten up their credit, that this might cause the Fed to slow down on their interest rate hikes because it will already start naturally slowing down the economy, which I think is basically just a dream at this point, because all of these things have a lagging effect. It even says so right here in the article, because as soon as these lenders start scaling back on the available credit, it takes time for it to fully play out in the economy, and therefore it's going to actually have a lagging effect. And by the time the Fed notices anything, it's already going to be too late. They're going to be continuing with their interest rate hikes like they said they're going to, which to me means that 2023 is just gearing up to be the perfect storm for all of this, because this is really going to be the year when all of these things are going to be coming together. You're going to see the effects of people being underwater on their mortgages. You're going to start seeing the effects of unemployment. We're going to start seeing the effects of businesses scaling back and laying off more employees. And it's not just me saying this, guys. The banks themselves are gearing up for this recession and ready to take massive losses. And you know how I know? Because it says right here. They're saying that the industry as a whole, meaning the banking industry, set aside about $13 billion just in the third quarter alone from expected credit losses. So these are going to be defaults that they're expecting to happen already just in the third quarter of this year. And that number is up from $10 billion from the previous quarter. So why do you think banks are setting more money aside and being less aggressive and less risky when it comes to giving out loans? Because they know that we are entering a period where the likelihood of people being able to repay the loans is literally dropping every single day right now. And so for me, I think it's important to just look at these things and really pay attention, because knowing this stuff can make the difference of whether or not you come out on the other end of this recession pretty much unscathed because you were ready for all of it, versus somebody that didn't have a clue and basically just keeps on going out and spending all their money and going further into debt, hoping that it's just all going to recover overnight. That's just like some people were saying from a video I did earlier this week, because I had a gold and silver sponsor. And guys, I am not going to stop doing the gold and silver sponsorships because I believe in gold and silver. So I buy gold and silver myself, and this video is not sponsored, but I'm just telling you right now that I have no shame in telling people that they should own some gold and silver, especially in uncertain times right now. And you know, if you don't want to do that, that's fine. That's your choice. I'm not your financial advisor. I'm not telling you you have to do it, but I'm just telling people that they should look at doing this if they have extra money to invest right now, because it's a historically sound asset to hold. And that's what I like. You know, I like stuff that's proven. I like things that have a long track record that I can pretty much be guaranteed I'm not going to lose my shirt on. But go ahead and do whatever you want, you know, invest in Open Door stock or invest in Blackstone or any of these other real estate funds that are doing so well right now. And because we're always talking about how bad things are going to be and where the housing market's going to crash and all of this, I want to give you guys some glimmers of hope here in this segment, because there was an article from Realtor.com today talking about where the housing market is most likely to actually see appreciation in 2023, because the market dynamics there are strong, the job market is strong, and a lot of these areas that we're going to talk about have a lot of ties to the education field and the healthcare field, manufacturing, good old-fashioned real work, stuff that contributes to the economy. What do you know? You know, these places are not filled with zombie companies living completely off of speculation. That's not what these places are. And so because these markets have strong fundamentals, they're poised to see growth in home sales, meaning the amount of homes that are being sold, as well as their listing prices and ultimately their sold prices. And here are some of these markets. They're in places like Hartford, Connecticut, El Paso, Texas, Louisville, Kentucky, Worcester, Massachusetts. I think I said that right this time, right guys? I know a bunch of people crushed me on the last time I mentioned that. Buffalo, New York, Augusta, Georgia, Grand Rapids, Michigan, Columbia, South Carolina, Chattanooga, Tennessee, and Toledo, Ohio. Now these are definitely not places that most people would be thinking about, oh yeah, I want to move there. You know, I've always thought about moving to Chattanooga. No, that's not really the case. But just like I was saying the other day about how more people are going to be looking at the Midwest due to its affordability and fundamentals being there, these are other places, and they're not all in the Midwest, guys. You have some places in the Northeast. There's even a couple in the South. You know, you have South Carolina on the list, Georgia. So there are options out there for people who are looking for a solid place to live where there's actually jobs, and what you're going to earn at your job is enough to pay for a home. And that's a good thing. So no matter what's going on in the world or with the housing crash, if you can find a good opportunity for yourself and your family, you should seize it. That's how I look at it. So a lot of people call this gloom and doom. I call it information you need to know, okay? So this could change someone's life, guys. That's how I look at it. Somebody could hear this and say, oh, I never thought about moving to Chattanooga, but you know, I always kind of like Tennessee. Maybe I'll check it out. And then they go there and they get a job, they buy a house, have a family, live happily ever after. You see what I'm saying? So you can spin this however you want in your mind as far as perception goes. You can call it gloom and doom. You can call it every day is just the most depressing news. But I look at all of it, and I mean all of it, guys, as opportunity. And the more you know, the less chance you'll have of making a mistake with something important when it comes to your finances or the housing market, as well as the fact that if you get a heads up on something like this and you could actually buy a new home or even an investment property in an area that could be seeing as much as 6% appreciation next year at a time when other housing markets are losing their shirt and going down by 20%, I think that's a win. And if you call that gloom and doom, well, I don't know what to tell you. And you know, I can tell from reading certain stories on the internet, and this is one that one of my subscribers, Carl, sent me, that a lot of people could really use information like this, because there was a story about a woman who is the sole breadwinner for her house. I'm not sure what she does. I don't think the article mentioned, but she makes 350 grand a year, which to most people would be like, you are rich. Even to me, I would think that as well, guys. I mean, if you make 350 grand a year, you could probably afford to buy one of these nice waterfront homes here in Miami. So that's a lot of money, and it puts you in the top 1% of earners, no doubt. But like we've talked about before, doesn't really matter how much you earn, matters how much you keep. And this woman's example is the perfect example of that. So she has about $88,000 in student loan debt right now, and she has 2 auto loans on electric vehicles that just those alone total 170K, which to me is outrageous, guys. And that's another thing. They talk about how much having an electric vehicle is going to save you money, and she's paying a 5% interest rate on those loans, so do the math. To me, that sounds like it's really gouging her pocket. And she also has a $4,500 per month mortgage, which is pretty expensive, and it didn't say where this woman lives, but I would imagine she lives in one of the big cities that obviously are very expensive, like here in Miami, or probably Los Angeles, San Francisco, somewhere where the cost of housing is very high, but you can also earn a high income. But get this, she says that after all of her expenses, these car loans, her credit cards, the student loans, her 401k contributions, taxes, and other bills, she's basically living paycheck to paycheck. What? How in what world, guys, can you live paycheck to paycheck making 350K a year? I mean, when I read that, I almost fell out of my chair, because you can earn half of that and live an amazing lifestyle when it comes to having nice things in life. And the fact that someone making this kind of money is struggling right now just goes to show you how financially inept people are. And that's why I make these videos, to try and help people not end up like this, essentially. And you know what her solution to all this is? You know what she's thinking about doing? She's thinking about taking out a $200,000 HELOC loan on her home right now, and her interest rate that's being offered is 9% on the HELOC, which is quite high for any type of loan, especially a $200,000 one. So she said this is going to help consolidate some of her bills and pay off the student loan debt and all of this and that. This is just what's totally wrong with everyone's thinking nowadays, you know? People get themselves completely in over their heads, just like this woman, and just like the government, because they're the best teacher, I guess, of all of this. What is their answer? More debt. I mean, let's fix debt with more debt. That's what our government does. And look how well that's working out for them. So if I was this woman contemplating this plan, would you really think that fixing your situation because you're basically living paycheck to paycheck with more debt is going to be a good idea? Obviously, this person needs help. And apparently she's going to be getting help, because she needs to get a financial advisor. She's being told to get a money coach, all this stuff right now, because apparently she has no idea what she's doing. This is another one where the house is just total garbage. They're selling this for the land value because it's waterfront property. This property's had a $250,000 price cut, starting off at $4.8 million back in September. Now today down to $4,550,000. Let's see what happens. Now, even if she does get this HELOC and that does solve some of her temporary problems with the student loan debt and maybe some of the car loan stuff, guess what, guys? HELOC loans are subject to rate increases. And if you haven't been paying attention, the Fed still has a few more rate increases to go, which means it's almost a guarantee that if she gets that HELOC loan at 9%, that it's going to be higher in a year from now. And imagine how vulnerable someone like this is. You have somebody that is living paycheck to paycheck, making $350K a year. They get the HELOC and your home is collateral for that HELOC. And then say she loses her job, or maybe she gets a pay cut, something like that. It's over, guys. This person, unfortunately, will probably lose everything in the event of a job loss, because you're just teetering on the edge of insolvency, you know? And you don't have the money printer like the government has to bail you out. So that's the biggest difference, you know? People running their lives like this that are treating their finances like the US government treats it are putting themselves in such a vulnerable position that they could be completely wiped out when this recession really takes root. Because, you know, if you're making that much money, I could see you being high up on the chopping block as a salary to get rid of from your company because they need to save money. Because if the company this person works for is actually one of them that's getting their credit cut back because times are tough right now, then who do you think is going to be going first? Probably the people that make the most money. That's my guess. And on top of that, she was thinking about investing in some out-of-state real estate opportunities that were presented to her. I don't actually have any information about the deals or where these properties are located, but she said that these investment opportunities could offer a 10 to 12% return on investment, but she's never seen them or anything like that, but she was thinking about investing in them. And that's what this whole article is about. It's about financial help. You know, people write in asking for help with their finances and asking if doing all this stuff is a good idea. It's like, I don't know how you can go through college, get all these degrees, and get this job paying all this money, but not know the answer to these simple questions, guys. And I'm not making fun of this person. I'm not really picking on her. I'm just exposing the fact of just how clueless people are with money. And by just knowing a few things can really save you right now. And that's what this person needs. She needs some financial education. I've walked past this house, I don't even know how many times already, probably at least 3 or 4, and no one's buying it. This one is just a joke at this point and shows the true state of the market. They have had this property listed for almost a year now, since February 2022, and they lowered the price in August $200,000 to $1,995,000. Finally in November they said, okay, let's rent it at $11,000, and it's still empty all this time. Oh, and by the way, if this was an HOA, I'd be finding this house. Look at this lawn. That grass is too long. Not keeping up with it. Don't fall into the trap that this woman has. She suffers from what's called Parkinson's law, and basically it means that the more money you make, the more money you spend, and people can get carried away with this to the point where you're still living paycheck to paycheck no matter how much money you make, guys. And I would never want to end up like someone like this. Thank God I am not like this person. I spend far less than what I actually earn, and I try to do that also by setting the example here on the channel, you know, and trying to make people realize that you don't need to do that to have a nice life. And we probably don't talk about that enough, but I'm going to try to start incorporating more of that theme into this channel because I think it's crucial now more than ever for people to be happy right now. And because I try to help as many people as I can with my channel, I want to make an important announcement for people who are active duty military. If you watch my channel and you're active duty military, or maybe you're not active duty right now, but you will be soon, you are entitled to save money on any type of loan that you have right now. We're talking credit cards, your mortgage, personal loans, auto loans, you name it. If you get turned to active duty military or you are active duty military, you need to pay attention to this, guys. Military personnel are missing out on about $9 million worth of interest savings every single year because of this one simple thing. Check this out. Got lots of cool Christmas decorations here too. So there is something called the Service Members Civil Relief Act. And what this does, it gives active duty military the opportunity to save as high as 6% on their interest rate for any type of loan or any type of debt that they have. And basically, this was designed to keep active duty military personnel focused on the mission at hand rather than, you know, their finances back home when they're trying to serve our country. The problem is why most military personnel miss out on these savings is because they're not aware of it, first of all. So that's why I'm talking about it here, so you can be aware of it. And all you need to do to take advantage of this is to apply for it, guys. And basically all you have to do is you call your creditors, anybody that you have a loan with right now, Tell them you're active duty. Sometimes they might request you to, give them an update every 60 days or whatever to make sure that you still are active duty, because they are going to be lowering your interest rate, which is actually going to save you a lot of money, which is why I'm bringing this up. The reason why I imagine most service members don't do this is because, you have lots of different credit cards and auto loans and whatever, and you have to call all these lenders individually, which kind of sucks. But I would start with the biggest ones, the ones that cost you the most money. Start with your mortgage. Call your mortgage servicer, tell them you're active duty. Then move on to your car loan. Tell them you're active duty. Move on to your credit cards where you have the most balances right now, which hopefully you have no cards with balances, but if you do, start with the ones that have the highest balances. Call them. Let them know you're active duty. Have a personal loan, call, let them know you're active duty, and you guys are going to save hundreds, if not thousands of dollars per year just by making a few phone calls. So if you didn't know this, make sure you do it, because it's going to end up saving you a lot of money. Every year, the National Association of Realtors puts together a profile of home buyers and sellers, and for the first time, they recognize that 5% of first-time home buyers were of other household composition, meaning that they weren't the typical husband and wife or the single person buying their own place to live. And the reason why this is significant is because that means 5% of the people that are buying homes right now are buying homes basically like in groups, like we've been talking about with people who have roommates. They're moving in together, trying to save money, and more people are starting to do this now when it comes to buying a property as well. And there was a recent story of a couple that did this out of Oakland, California. They bought a multifamily building in Oakland and invited a bunch of their adult friends to move in. And fast forward to today, they actually have 17 adults and 2 infants living in this property right now, because they basically pooled together their resources and bought it together. And they said that the reason they did this was not just financially, but because they didn't want to leave all their friends behind. And instead of leaving all their friends behind, they decided to find a way where they could all move in together. Now that sounds like the definition of the hippie movement. So it sounds like the hippie movement's still alive and well in this part of the country. And the thing that gave me a laugh out of this is it says that if you're going to do this with people, it says you really have to get a little bit financially naked with the person that you're buying with. There has to be a lot of transparency. So my first thought was, yeah, you're going to have to get more than financially naked when you're living with that many people. You know what I mean? All jokes aside, is this a viable way to buy property? Yeah, it is. You can definitely save some money and buy property with friends and family and pool together your resources, guys, but it does come with its downsides, okay? If you're gonna do something like this and you're buying property with someone you're not married to, you need to seek legal counsel and have them draft a cohabitation agreement for you to basically determine how different disputes, how a sale would be handled. All these things are extremely important to figure out ahead of time if you're going to buy real estate with other people like this, because as you can imagine, things can get pretty hairy. You own the place with 5 people and 2 people want to sell their share, and whatever happens, there's a lot of things that can happen and change in people's lives. And when there's that many people that own one property, you can see how things can get sticky very fast. So if you're going to do something like this, make sure you hire an attorney and have all of your T's crossed and your I's dotted with something like this. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I put out a new video. And if you don't want to wait, check out my next video on the screen right over here, and I'll see you in the next one.